Hello students. Today in this video we are going to discuss the third chapter of accountancy of class 12th, reconstitution of partnership firm, admission of a partner. In this video we are going to discuss about the accounting treatment of goodwill. As we have already discussed that whenever a new partner comes to the firm, that particular partner must bring additional amount as a share of his goodwill. The incoming partner who acquires his shares in the profits of the firm from the existing partners bring in some additional amount to compensate them for the loss of their share in super profits. It is termed as his share of goodwill, also called premium. Whenever a new partner comes to the firm and he brings additional amount, that amount that he brings is known for the goodwill, or that amount is known to be premium. So basically, whenever a new partner is admitted, goodwill can be treated in two ways. One, by premium method, and second, by revaluation method. Now we will discuss about the premium method. This method is followed when the new partner pays his share of goodwill in cash. The amount of premium brought in by the new partner is shared by the existing partner in their ratio of sacrifice. So whenever a new partner brings his share of goodwill in cash, at that moment of time we use the premium method, and whatever amount he will bring as his share of premium will be distributed among the old partners in their sacrificing ratio. And we have already discussed about sacrificing ratio in our previous video. If this amount is paid to the old partners directly, that is privately by the new partner, so no entry will be made in the books of the firm. It means if a new partner pays his share of goodwill in cash or pays his share of premium in cash to the existing partners privately outside the business, then no entry will be made for the same, as it has been paid privately outside the business. So no entry will be made in the books of account. Now, whenever but when the amount is paid through the firm, which is generally the case, the following journal entries are passed. So whenever new partner brings his share of goodwill in cash, then the entry that we are going to make is cash account debit to premium for goodwill account. So whenever a new partner brings his share of premium or his share of goodwill in cash, then the entry that we are going to make is cash account debit to premium for goodwill account, because cash is coming and cash is a real account. As per the rule of the real account, debit what comes in, and he's bringing the same amount for the premium for goodwill. So your entry will be, first entry will be cash account debit to premium for goodwill account, and the second entry for the same will be premium for goodwill account debit to existing partners capital account individually. So the share that has been brought by the new partner as premium, the same amount will be distributed among the existing partners, or you could say the old partners, in their sacrificing ratio. So this is the point to note, that whenever a new partner comes in the firm and brings additional amount for the share of premium, then the amount that he is going to bring as premium will be distributed among the existing partners in their sacrificing ratio. So to distribute the premium amount that has been brought by the new partner among the existing partner, for that we have to calculate the sacrificing ratio. It means the important thing that we have to calculate the sacrificing ratio, and we have already discussed in a previous video how to calculate the sacrificing ratio. Alternatively, It is credited to the new partner's capital account and then adjusted in favor of the existing partners in their sacrificing ratio. In this case, the journal entry will be as follows. Cash account debit to new partner's capital account. So, whatever amount that will be brought by the new partner for his share of goodwill as premium, the entry for the same can be done cash account debit to new partner's capital account. Then the same will be adjusted from the new partner's capital account to the existing partner individually. The entry for that will be new partner's capital account debit to existing partner's capital account. And this distribution of goodwill will be made among the existing partner in their sacrificing ratio. So, one thing to be remember and note that whenever a new partner brings his share of goodwill in cash, the same will be distributed among the existing partners in their sacrificing ratio. Means the amount of premium that the new partner is going to bring will only be given to these partners or the existing partner who have sacrificed in favor of the new partner. If the old partner does not sacrifice, then in that circumstances he is not going to get the benefit of the premium. So sacrificing ratio is of noteworthy. If the partners decide that the amount of premium credited to their capital account should be retained in the business, there is no need to pass any additional entry. It means whatever share of premium that has been distributed among the existing partner in their sacrificing ratio, if they want to retain the same in the business, then no further entries are to be recorded. However, if the existing partners wants to withdraw their amount in full or in part, then the following journal entry will be passed. Existing partners capital account debit individually to cash account. So here whatever share that will be given to the existing partner, if they want to withdraw that amount, then the entry will be existing partners capital account debit to cash account. So even the existing partner can withdraw their share of goodwill in cash if they decide so. Now we can understand it with the help of this illustration. Now in this example, Sunil and Dalip are partners in a firm sharing profit and losses in the ratio 5:3. Sachin is admitted in the favor in the firm for 1/5 share of the profits. He is to bring in 20,000 as capital and 4,000 as his share of goodwill. Give the necessary journal entries. When the amount of goodwill is retained in the business, it means the partners are not going to withdraw their shares of premium. Second, B, when the amount of goodwill is fully withdrawn, means here whatever share the existing partners are going to have, they are going to withdraw it fully. See, when 50% of the amount of goodwill is fully withdrawn, means whatever share of goodwill will be there of the new, existing partner, they are going to withdraw 50% of the same amount. So how we are going to deal with this situation, or how we are going to deal with this case? Now let's start. Now as in this case, Sunil and Dilip, they are partners, they are sharing their profits in the ratio 5:3. So the new partner has been admitted for 1/5 share. So it's a plain statement, and as we have already discussed in our previous video, that if it is a plain statement, then the sacrificing ratio will be equal to your old ratio. So here the sacrificing ratio will be 5:3. Now Sunil and Dilip are partners in a firm sharing profit and losses in the ratio 5:3. So here the sacrificing ratio will be same as your old ratio 5:3. He is to bring in 20,000 as capital and 4,000 as his share of goodwill. So for his share of goodwill, he is bringing 4,000. Now the first case, when the good amount of goodwill is retained in the business, it means we are going to retain the amount in the business. Now your entry will be cash account debit to Sachin's capital account 20,000 and to premium for goodwill account 4,000, and the total of the same 24,000 will be transferred to cash account as 24,000 is coming into the business. 20,000, the amount of capital that has been brought by the new partner Sachin, so it will be transferred to Sachin's capital account, and 4,000 has been brought by him as his share of premium. So 20 plus 4, 24,000. Now the second entry will be this amount of goodwill or the premium for goodwill will be distributed among all partners in this sacrificing ratio. And as I've told you already that the sacrificing ratio will be 5:3. So the amount 4,000 will be distributed between Sunil and Dilip in the ratio 5:3. So the share of goodwill, clear, that Sunil is going to have is 4,000 into 5 by 8. It means 8 5 are 40, 5 5 are 2,500. So 2,500 rupees will be the share of Sunil. The same way we are going to calculate the share of Dalip. So Dalip shares will be 4,000 into 3 by 8. So it's coming 1,500. So Dalip shares will be 1,500. Clear? Now it has been said in the question that they are going to retain the amount in business, means further we are not going to do any entry. So we'll just do the 2 entries. Now second case. In second case it has been given that the existing partners or the old partners want to make the withdrawal of the share of goodwill. Now in this case your first entry will remain same, the second entry will remain same. Now for withdrawal one additional entry has to be done, as it has been said in the question that Sunil and Dilip wants to withdraw their share of goodwill fully from the business. Now for the same the entry will be as they are withdrawing the amount. Sunil and Dilip are personal accounts, so as per the rule debit the receiver and cash is going out, credit what goes out. So the additional entry that we are going to do in case B, first two will remain same. The third entry will be Sunil's capital account debit, Dilip's capital account debit to cash account. Sunil's capital, the share of Sunil is 2,500, so we are going to withdraw 2,500. Dilip's share is 1,500, so we are going to withdraw 1,500. Clear? And to cash account, in total the 4,000 rupees will go out from the firm. So your entry will be Sunil's capital account debit 2,500, Dilip's capital account debit 1,500, and to cash account 4,000. So this is how they are going to withdraw the amount from the business of this share of goodwill. Now looking into the third case C, when 50% of the amount credited to the existing partner is withdrawn. In this case, Sunil and Dilip, these two old partners are going to withdraw 50% of their amount of goodwill. As we have already calculated their share, Sunil's share is 2,500 and Dilip's shares is 1,500. So half of the same they are going to withdraw. So what we'll do, we will make the half of 2,500. So half of 2,500 means divided by 2. So it's coming 1,250. The same way Dalip is also going to withdraw half of his share. So 1,500 divided by 2, as 1,500 is the share of Dilip. So it's coming 750. So both of them wants to withdraw their amount. Now, if we have been asked for your C part, clear, then in that case first entry will remain same. The first entry will be of bringing your cash for capital as well as for the share of premium, as the new partner is bringing his share of goodwill in cash as well as his capital in cash. So your first entry will remain same. In case C, your first entry will be cash account debit to Sachin's capital account to premium for goodwill account. Cash account debit 24,000 to Sachin's capital 20,000 and to premium for goodwill account 4,000. The second entry will remain the same. Goodwill account debit or premium for goodwill account debit 4,000 to Sunil's capital account 2,500 to Dalip's capital account 1,500. Now in case C, one additional information has been given that 50% of the amount of goodwill credited to the existing partner is withdrawn. So what Sunil will do, the half of his share, means out of 2,500 he is going to withdraw half amount, and Dalip out of 1,500 is going to withdraw half amount. So as they will receive, debit the receiver and the amount, the cash will go out, credit what goes out. So your third entry will be Sunil's capital account debit 1,250, means half of 2,500. Dalip's capital account debit 750, half of 1,500. To cash account, the total of this means 1,250 plus 7,500 means 2,000 will be withdrawn by them. So here the entry will be, the third entry will be Sunil's capital account debit 1,250, Dalip's capital account 750, to cash account 2,000. So this is how we are going to treat these situations. Now further, we can understand it with the help of another example. Vijay and Sanjay are partners in a firm sharing profit and losses in the ratio 3:2. So we have two partners, Vijay and Sanjay. The profit sharing ratio has been given as 3:2. They admitted Ajay into the partnership with 1/4 shares in profit. So the new partner that has been admitted for 1/4 share, Ajay. Ajay brings in rupees 30,000 for capital and the requisite amount of premium in cash. The goodwill of the firm is valued at rupees 20,000. So it has been given in the question that Ajay brings 30,000 for his share of capital and the requisite amount of premium in cash. The goodwill of the firm, here you have been given with the goodwill of the firm, means first we have to calculate the share of new partner here, means the amount that he is going to bring as premium we have to calculate out of 20,000 and Ajay is coming for 1/4 share. So out of 20,000, 1/4 shares will be of the new partner Ajay. The new profit sharing ratio is 2:1:1. So in this question you have been given with old ratio as well as with the new ratio. Vijay and Sanjay withdraw their share of goodwill, give necessary journal entries. Now in this case we have to calculate, the first thing that we have to do is we have to calculate the share of goodwill of Ajay. Firm's goodwill has been given to you. We have been given with firm's goodwill. So out of firm's goodwill, you have to calculate Ajay's shares, new partner. As we know, Ajay's shares is 1/4. So 20,000 into 1/4. So it means 5,000. So 5,000 will be the share that will be brought by Ajay for his share of goodwill. Then second thing that has to be calculated in working note, we need to calculate the sacrificing ratio. As we have already discussed in our previous video how to calculate sacrifice. So sacrifice is equals to old share minus new share. Here you have been given with the old share Vijay. If we talk about Vijay's old share is 3 by 5 and his new share is 2 by 4. Clear? So by solving it, we'll get the sacrifice of Vijay, and it's coming 2 by 20. It's coming 2 by 20. Now the same way we are going to calculate for Sanjay. If you talk about Sanjay's old share is 2 by 5 and his new share is 1 by 4. Clear? So if we'll calculate it, it's coming 3 by 20. So with the help of this, we can calculate our sacrificing ratio, and it's coming 2:3. So this is the sacrificing ratio. This is what your sacrificing ratio. As we have already studied, that this amount of goodwill, or you could say the premium amount of Ajay, is going to be distributed among all partners in their sacrificing ratio, and at sacrificing ratio is coming 2:3. Clear? And Ajay's share of goodwill is coming 20,000 into 1 by 4. It's coming 5,000. So out of 5,000, clear, Vijay's share will be 5,000 into 2 by 5. It's coming 2,000. It's for Vijay. And for Sanjay, it will be 5,000 into 3 by 5. It's coming 3,000. So this is how we are going to calculate the share of Vijay and Sanjay. Now we can do the journal entries. Already we have done with our working notes. The first entry is cash account debit to Ajay's capital account, as is bringing 30,000 for capital, to premium for goodwill. As we have calculated, the share of premium is 4,000. Oh, sorry, 5,000. 20,000 into 1 by 4, that is 5,000. So your entry will be cash account debit 35,000, to Ajay's capital account 30,000, and to goodwill 5,000. Then the second entry that we are going to do is we are going to transfer the premium to old partners in their sacrificing ratio. So the entry for that will be premium for goodwill account debit 5,000, as his share of goodwill or premium is 5,000. So entry will be premium for goodwill account debit 5,000, to Vijay's capital account 2,000, and to Sanjay's capital 3,000. Now it has been given in the question that they are going to withdraw their amount of goodwill. So one additional entry will be there. Vijay's capital account debit, as his share is 2,000, he is going to withdraw 2,000. Sanjay's capital account debit, as his share is 3,000, he is going to withdraw 3,000, 3,000. To cash account total 5,000. So your entry will be Vijay's capital account debit 2,000, Sanjay's capital account debit 3,000, to cash account 5,000. Clear? So this is how we are going to solve this example. Now the above example that we have solved is on the assumption that there is no existing goodwill in the firm, means there is no goodwill in the books of accounts. So whatever new goodwill will be valued, the same is going to be treated. Now if goodwill already exists in the books of accounts, means when a new partner comes in the firm, clear, on the admission of that particular partner, already the old partners or the old firm has goodwill in its asset side. Then in that situation, we are going to make the treatment of the old goodwill, or we can say when goodwill already exists in the books of accounts. Now, it is quite possible that when a new partner brings in his share of goodwill in cash, some amount of goodwill already exists in the books of accounts. Means new partner is also going to bring his share of goodwill in cash, as well as existing goodwill will be there in the books of accounts, or you could say in the books of old partners. Then in that situation, the old goodwill or the existing goodwill is to be written off in old partners capital account, or it will be debited to old partners in their old profit sharing ratio. This has to be noted that it has to be distributed among them in their old profit sharing ratio. In old profit sharing ratio means the existing goodwill will be distributed among the old partners in their old profit sharing ratio. So the entry for the same will be partners capital account debit to goodwill account. Clear? Like for example, if we take the example 17, clear, the goodwill of the firm is valued at rupees 20,000 and Ajay, who is admitted for 1/4 in the profit, brings 5,000 as his share of goodwill. Suppose goodwill already appeared in the books at rupees 10,000. Suppose goodwill already appears in the books at rupees 10,000 and there is no decision to retain it. In that case, after crediting Vijay and Sanjay for the amount of goodwill brought in by Ajay, that will be done. So we are going to treat as we have already discussed in illustration 17, but with additional information that already goodwill appears in the books at rupees 10,000 and the old partners does not want to retain it. Then in that situation, this old goodwill will be distributed or will be written off among the old partners in their old profit sharing ratio. And the old profit sharing ratio between Vijay and Sanjay is 3:2. So out of 10,000, the old goodwill share of Vijay will be 3/5. So it's coming 6,000. The same way, the share for the another partner Sanjay will be 2/5. That's coming 4,000. So this is how we are going to calculate the share of old partners in the existing goodwill. As I've told you the entry, old partners capital account debit to goodwill account, and this will be distributed in their old profit sharing ratio. So whenever you will be given with the existing goodwill in the books of account, the same has to be written off among the old partners in their old profit sharing ratio. Note, in their old profit sharing ratio. Now we can understand with the help of example. Srikant and Raman are partners in a firm sharing profit and losses in the ratio 3:2. They decided to admit. No. Srikant and Raman are partners in a firm sharing profit and losses in the ratio 3:2. They decided to admit Venkat into partnership with 1/3 share of profits. Venkat brings 30,000 as his share of capital. He also promises to bring in the necessary amount for his share of goodwill. On the date of admission, the goodwill has been valued at rupees 24,000. And the goodwill account already appears in the books at rupees 12,000. Venkat brings in the necessary amount for his share of goodwill and agrees that the existing goodwill account be written off. Now, in this question, you have been given with there are two partners, Srikant and Raman. Their old profit sharing ratio is 3:2. Venkat, the new partner, has been admitted for 1/3 share, as it's a plain statement. Clear? So the sacrificing ratio will be same, 3:2. Venkat brings 30,000 as his capital. He also promises to bring the necessary amount for his share of goodwill. So he promises to bring his share of goodwill. Now, out of the firm's goodwill, it has been valued firm's goodwill 24,000. So this is firm's goodwill, 24,000 is the firm's goodwill. So what we have to do? We have to calculate the share of new partner out of it. So divided by 3, because 1 by 3 is the share of new partner. So it's coming 8,000 rupees. So new partner is going to bring 8,000 rupees as his share of goodwill. Then already the goodwill account already appears in the books 12,000. It has been given in the question that it's already appears in the books at rupees 12,000. So here you have been given with the old goodwill. This it has been, the goodwill already appears in the books at rupees 12,000. So this is your old goodwill, and as I've told you that this old goodwill is going to be distributed among old partners in their old ratio, and that is 3:2 between Srikanth and Raman. Then you have been asked to pass the journal entries for the same. Now the first entry will be, as he is bringing his share of capital and goodwill in cash, so the entry will be cash account debit 38,000, Venkat to Venkatesh capital account 30,000, and to premium for goodwill account 8,000. As his share we have already calculated as 8,000. Then the same will be distributed among old partners in their old ratio. This amount that has been brought by new partner as his share of premium, the same will be distributed among old partners in their sacrificing ratio. Now the entry for the same will be premium for goodwill account debit 8,000 to Srikanth's capital account. Clear? So how we are going to calculate Srikanth's capital share? Out of 8,000, Srikanth's shares will be 3/5. Okay, so 16, so it's coming 4,800. The same way we are going to calculate for Raman. Raman's shares will be 8,000 into 2/5. Clear? So it will come 3,200. So the share of Srikanth will be 4,800 out of 8,000, and for Raman it will be 3,200 out of 8,000. Now the second entry will be premium for goodwill account debit to Srikanth's capital account 4,800 to Raman's capital account 3,200. Now it has been given in the question that already exists in the books. The goodwill already exists in the books of account at rupees 12,000. This is old goodwill, and this old goodwill will be distributed among old partners in their old ratio. In this question, Srikanth and Raman are the old partner, and their old ratio is 3:2. So this 12,000 will be distributed among Srikanth and Raman in the ratio 3:2. So for Srikanth it will be 12,000 into, so it will be out of 12,000, clear, his share will be it will be 12,000 into 3/5. Clear? So it will be 7,200 for Srikanth, and for Raman it will be 12,000 into 2/5. It's coming 4,800. Clear? So this is how we are going to calculate the share of Srikanth and Raman in old goodwill. So and the entry for the same will be Srikanth's capital account debit. Your third entry will be Srikanth's capital account debit 7,200, Raman's capital account debit 4,800, and to goodwill account 12,000. So this is how the old goodwill will be written off among the old partners in the old ratio. So this is all about your premium method. Now the second method that we are going to discuss is your revaluation method. Second is your revaluation method. This method is followed when the new partner does not bring his share of goodwill in cash. So if the new partner does not bring his share of goodwill in cash, then in that situation we use revaluation method. and the entry in this situation will be new partners capital account debit to old partners capital account, or you can say gaining partners capital account debit to sacrificing partners capital account, as the new partner does not bring his share of goodwill in cash. So in this situation we are going to adjust the amount of goodwill or the amount for premium of the new partner with the capital accounts, or we can adjust it with the help of the capital accounts, and the entry for the same will be new partners capital account debit. The entry you are going to do is new partners capital account debit to old partners capital account, to old partners capital account, or you can say gaining partners capital account debit to sacrificing partners capital account. So this is how we are going to deal with the amount of goodwill that will be brought by the new partner in cash, or it will be adjusted through their capital accounts. Thank you. I hope you like this video.